when I look at the peer lending marketplace, it's really just become a marketplace for credit, whether it's small business or personal loans. I think one evolution that's occurred over the past 18 months that everyone can attest to is the funding sources for these marketplaces. What started initially in some businesses as balance sheet only lenders or investor only lenders, or in some instances a hybrid of that, is now morphed even further, where you've got historically balance sheet lenders now securitizing product and operating marketplaces. You've got individuals investing in loans in fractional format or high net worth in whole loan format. And really the marketplaces have changed very much in the last 18 months, probably quicker than the weather today, which was terrible this morning, but it's looking pretty nice out now. For this panel, we've got 4 great panelists. I'd like to just let each of them introduce themselves and just their firm and what they do there. You want to start?
Hi, I'm Zhengyuan. I'm from OnDeck. I run their capital markets business, which includes, capital raising, funding, and treasuries and marketplace as well.
Good afternoon, everyone. I'm Candace Klein, and I'm with DealStruck. DealStruck is a commercial peer-to-peer lender. We are differentiated in the marketplace because we have multiple products ranging from term loans to asset-based lines of credit to inventory lines of credit and beyond.
Hi everyone, my name's Oren. I'm a co-founder of Pave. We are a online lending platform focused solely on the millennial demographic. So that means we're really providing credit in the form of unsecured short-term loans at hopefully low interest rates to people generally with thin files having difficulty accessing credit elsewhere, and hopefully at better rates as well than the other players in the market.
Hi, I'm Kathryn, Petralia, co-founder and COO of Kabbage. We provide automated access to small business loans and now consumer loans at kabbage.com and carrot.com with a K.
If you look at OnDeck, I've established a platform where we used our proprietary model to get to the OnDeck score, and then we lend over $1.5 billion in the market. If you look at the funding side of the business, I think we run a pretty unique model, which is sort of a hybrid. So, we fund our loans on balance sheet as well as in marketplace. So on the on-balance sheet side, we obviously recently did rated securitization, and it was very well participated by, a lot of institutional investors, mutual funds, insurance companies, and money managers and hedge funds across the board. And then on the marketplace side, institutional investors are able to purchase whole loan from us where we retain servicing. So, I think there's obviously a lot of demand in the market, and a lot of hedge funds are chasing for assets. I think what we're very focused on is essentially create a sustainable and diversified funding source for OnDeck over a long period of time. So small business will able to access capital through OnDeck. It doesn't really matter what the market environments are. And to do that, you really have to create diversity in your funding sources. And the way we're sort of looking at it is, the key is not only build a diversified investor base, but also build different diversity in investor types, right? So in a way, like insurance companies have very hard time buying whole loans because they're regulated by NIC and they can't really buy whole loan assets. So in a way, we created a platform where you can get exposure on OnDeck's asset class through and pick the risk appetite you wanted to take. So you can buy investment grade bonds or below investment grade bonds, through our securitization platform, or you can purchase whole loans from our marketplace platform. And then from the innovation perspective, I think we're very focused on serving small businesses, and they have a lot of different financing needs over time. Whether it's factoring, line of credit, equipment leasings, or there's just a variety of product that they would need financing needs. So we're working continuously to innovate and get better financing product to our small businesses.
Great, thanks.
So at DealStruck, our mission as a company is to graduate our borrowers into a path to bankability over time. And so when we look at who our customers are, we have two. Like any marketplace lender, we have our borrowers and our lenders. As it relates to our borrowers, we're really serving the mid-prime market. And so this is a borrower who cannot get a bank loan. They've been turned down by the banks. They typically are going to OnDeck or Capital Access Network. They're going to a daily debit provider for their first round of capital, typically their first $50,000. And once they've been financed once or maybe even twice by one of our friends like OnDeck or Capital Access Network, they'll refinance into our products. And so we'll typically start them off with a combination of products from a term loan and asset-based line of credit. We've seen that a lot of our borrowers most recently have lumpy cash flow. They're seasonal businesses. And for that reason, we've now rolled out our inventory-based line of credit. And so that's a new product that we've just innovated on in the past month. And so we see that our businesses are coming to us with differing needs. And luckily, our team has done about 6 different types of products in the past. They've underwritten and funded 6 different products. And so we'll continue to innovate in offering new and diverse products to these borrowers. Our goal is to be refinanced out of business with each borrower. So our hope is that they'll stay with us for 2 or 3 products for that life cycle, and then they'll go into a banking relationship. And we've successfully refinanced a handful of them already, and we've only been lending for a year. As it relates to our lender base and who that is, our market tends to, we raised our first $10 million, $100,000 at a time. It was brain damage for me and members of our team. And that was primarily with high net worth individuals. Capital markets have really changed in the past 9 months or so as we've seasoned our portfolio, kept our default rates down, and innovated on product. And so we've found now that the institutional investors are eager to partner with us at this point. And it's a matter of choosing the right partners. We are still diverse, so we are still taking capital from the high net worth individuals. We have several different structures set up. We have a mezzanine debt pool. We have a fractionalized market, and we are selling the whole loans as well. One interesting partnership that we have is with other lenders. So we have lenders both upmarket and downmarket who realize that they are potentially losing customers to us. And they said, okay, if they're going to refinance out of us anyway, we'll allow them to refinance into your DealStruck product, and then we'll come in after the product seasons for some period of time, and we'll buy the note again. And so we're finding that other lenders are a great capital source for us as well, and that will cause us to continue to innovate and add new products as we grow.
Great. Oren?
Yeah, so at Pave, we really, our mission is all about providing the future generation, millennial generation, with the right type of funding to enable their success. We've seen, over the last 2 years that we've been in business, we've seen thousands of people very creditworthy, but because of the way traditional lenders look at them, actually unable to access reasonably priced credit. So what we did at Pave is we developed an underwriting model that actually goes well beyond FICO, adjusts FICO, but takes into account other variables such as education and income to assess creditworthiness in a hopefully more accurate and granular way. And what we're providing to our borrowers is really access to hopefully better priced credit, and also from a brand that they actually resonate with. So for millennials, which is approximately a 45 million person market, individual market, what they really want is to have a much more personal approach from their funding source. So there's a huge anti kind of feeling for banks. And what we discovered over the last couple of years is that the values that they really value in a brand from their money is to have it obviously affordable, but very simple and very human. So everything we do at Pave is provide a much more human approach, and that's shown through the educational type of content that we produce, allowing them to actually improve their personal finance situation, to also actually having a very big focus on customer service. We actually launched the loan product 1 month ago, and so far we funded about $500,000 of loans. We're in the early stage of building out the investor base. So, as you mentioned, we're at the moment talking to a lot of high net worths who are investing. We do have some institutions starting to invest on the platform as well. The idea is on the investor side to build out a very diversified set of investors with from the investor perspective, this being a very interesting exposure, because this demographic, i.e. people 20 to 35-year-olds, is a demographic that currently isn't being offered by other lending platforms such as Lending Club and Prosper. I guess the main use cases for our borrowers are education, refinancing such as Prosper Lending Club, but also one-off purchases to moving to New York, for example. And so the rates we target are rates that are really prime and emerging prime. So it's at the moment we're concentrating solely in New York, so the rate's around 6 to 16%.
Great.
So we started the company in 2009, but we didn't put out any money until 2011 because we spent those 2 years partially raising equity, which was really a challenge during that time, where we had the question asked often, do you think you're going to be able to raise the debt to support this business? And of course, nobody would ask that question today. But we were building a technology platform. And so what's interesting about that is it allows us to offer a different type of product. And I'm just going to talk about the business side for a minute. So we're able to, we stay connected to the data sources that our customers provide to us. So I provide a line of credit to them, and means that our securitization facility, similar to OnDeck's, it's a rated one, but it's a little bit more like a credit card securitization because the customers are constantly using the funds. And so that's basically on balance for us. And we've transitioned through a lot. I think this is our 4th or 5th facility, not like the one we have today, but because we had to sort of jump through a lot of hoops each time as we grew. So it's great now that there's so much access to capital. Of course, we worry about what the next cycle is going to bring. But on the consumer side, I'm actually doing something a lot more like what these guys are doing on the marketplace side. So we're selling those loans entirely. We launched a consumer product because, frankly, there were a lot of consumers coming to see us who were just starting up, and there was no business history. So we were able to take that data and create a different type of product that allows consumers to borrow, and a lot of them are doing it to start businesses.
Great.
Let me so I think there's I think there's something in general in marketplace lending and why this market is growing. There's a misconception of rates is not the end all and be all ultimately, right? U.S. Postal Office ships packages as well, but you choose to use FedEx and UPS. Why? Because speed, ease, and convenience, right? If I were to tell you 40% of our portfolio are 700 plus FICO, and doctors are the 3rd largest group of our borrowing base, that's a surprising stats, right? But ultimately, what you're thinking about is people choose to use a lot of these online platforms, including OnDeck, because speed and convenience, right? New York Fed actually recently had a study. The average search time per bank is 26 business hours. Who has that kind of time? So I think I think what everybody here has created is not only just sort of what's the cost of borrowing, but it's also what's the speed and convenience of borrowing, and that's a very important factor to that as well.
Yep, and I would imagine for small businesses, especially if they buy the inventory, they know they can fill the order. And Kathryn, I'd imagine you feel the same way with speed.
Right, that's the number one reason that our customers say they love working with Kabbage. So on average, our customer requires about 7 minutes from the time they land on the site until they have funds in their account. And they can get money in a couple different ways. They can do it via PayPal if they use PayPal, but most of our customers today don't. So they can take the funds via ACH, so that takes a couple days, or they can via their debit card get the funds instantly deposited into their checking account. So someone can actually have money in their checking account in 7 minutes. And that's the whole application process. And the reason we can do that is because all of the data collection is automated. We're going to the sources that they're using to run their business, whether it's QuickBooks or whether it's a payment processor or whether it's Google Analytics or lots of different sources. And so we can quickly come to a decision and give them the cash.
Awesome. Thank you for that.
Thank you.
So I'd like to change gears a little bit. I'd like to hear more about, Candace, you touched on this before, so maybe you can kick this off. How you guys are working with incumbents in this space. You talked about how you want your borrowers to graduate to the banked population or be served by commercial banks. And then I'd like to hear how other groups are partnering or thinking about partnering with other competitors or incumbent lenders in the space.
Sure. So first, just as it relates to the need for speed, I think that Kabbage and OnDeck and others play a very important role in providing that speed. We don't. Our loans take 7 to 10 business days to fund. And so it does take a bit more time. And if there is an urgency, we actually will say, if you have urgency, go to a provider who can give you that urgent need of capital and then refinance into us over time. And so what happens oftentimes is the borrower will have that very urgent need. They will then begin paying on that urgent need, and they'll realize that the cost is overwhelming for them, and then they'll need to refinance. And so we serve as the next step in that cycle. As it relates to partnering with incumbents, we have a few incumbent partnerships in place. And so we partner with CDCs, CDFIs, community banks, and credit unions. All of those players do not offer lines of credit. So they're typically SBA lenders. They're typically taking anywhere from 90 days to 6 months to fund their loans. And they're losing their borrowers in the process to lenders who can do so faster. So we do a couple of things for those partners. We offer a side-by-side line of credit where we'll be second position player to them. They give us priority over the accounts and chattel paper. We guarantee payment back to them. So it works out very well for those SBA lenders because they're getting a guaranteed payment that they didn't get before because we have control over the bank account. And the borrower benefits because they have a revolving short-term capital line as well as their term loan from the SBA. The second way that we partner with the incumbents in the traditional lender side is we offer bridge loans. So quite often a borrower will come to us, they'll be in the process of applying for an SBA loan, we'll fund them with an interest-only 6-month loan, and then we expect fully to be taken out by the SBA lender within that period of time. If the SBA lender doesn't take us out, we just simply underwrite it as if it was a fully underwritten loan. We reprice it at that 6-month mark, and the borrower continues to pay at the repriced amount. As it relates to the down market providers, it's interesting. The down market providers are seeing us as an opportunity to continue to build their balance sheet with grade A paper. So these borrowers are already refinancing into our product. The lenders are coming to us saying, okay, we want to watch the season for 90 days and see if the borrower actually repays it at your lower interest rate. And if so, then we'll buy that paper back from you. We'll keep it as grade A paper on our book. And as we go through our securitization, it helps us to have higher, better performing paper. So that's something that's working. The final way that we're partnering, and then I promise to shut up and let other people talk, is we're handling workouts. So with both the traditional lender and the lower market lender, they're having deals where borrowers stopped paying. Many times it's because that borrower was given the wrong product in the beginning and they can't afford the payment, or they needed something that was a different solution. And so that's one where it's not just giving us referrals of your turn downs, it's saying, give us your problem portfolio and we'll refinance that problem portfolio for the borrower and take it off of your books.
Thank you, Candace. Oren, do you want to talk a little bit about how you are or plan to partner with banks and
Sure.
other incumbents?
Sure. So obviously, we launched the loan product 5 weeks ago, and what we're seeing in the market, I think, is a kind of a nichification and a specialization here. So you have companies who are focused on student loans, such as SoFi and Common Bond. Obviously, you have Prosper Lending Club focused on consumer loans for slightly older demographic. And the way we're starting to partner and think about partnering is actually on a product basis. So we're very much focused on 2- and 3-year unsecured consumer loans, but a lot of our customers come to us and sometimes erroneously want to actually refinance student debt at a higher rate. And we're saying, listen, we're obviously about supporting you, doing the right thing economically. You shouldn't be refinancing a 7% loan at 9%. So, and on a shorter term basis. So we refer them obviously to SoFi and Common Bond. And we are talking to, I think you guys at Prosper, John, also about people that are slightly out of our demographic. Now, obviously, regulations make it slightly difficult to turn people away, on certain criteria. But I think the exciting thing is that with all the different lenders coming up now, even for looking for small business loans that we don't underwrite, we can actually refer our borrowers over to other platforms, and we can have these types of relationships going forward.
Great, thank you for that. Kathryn, do you want to touch on how Kabbage has worked or partnered with incumbents?
Sure. So 60% of our business borrowers bank with the top 3 banks in the U.S. and 90% of them bank with the top 10. So what this means is these are mainstream businesses with mainstream checking accounts, but their banks are not able to serve them, not because they don't want to, but because they don't have the technology to do it. There was a recent Harvard business study, OnDeck and Kabbage were both mentioned in there, and they were talking about the need for small dollar loans. So the greatest demand for small business borrowers is sub $50,000. And so the banks just don't have the tools and technology to economically originate those loans. We were at an event where John Stump was moderating our panel. He's the CEO of Wells Fargo. And we thanked him for allowing our business to exist because he was unable to serve those borrowers. And he was like, holy crap, we should talk to you about that. So what we're doing is talking with all these banks about how they can use our platform. I don't want to compete with those banks. I want to help them serve these businesses more efficiently. They have a lower cost of capital. They have a better relationship so they can manage risk more effectively. And they don't have to pay the same marketing costs we do. So we think it makes a much more efficient market.
Thank you. Lou, I've read some press releases about OnDeck partnering with banks.
Yeah, I would echo with Kathryn. I mean, I think it's interesting. You roll back the clock 2 years. I think bank were fighting the alternative lending space. I think now they're sort of turning into believers, in the sense that bank has recognized that small, working capital loans are not something they're good at, and they're offering their customers. And we have a lot of bank partnership that's we recently launched with BBVA Compass, where essentially they're white labeling OnDeck's products. So BBVA, we basically take the business checking account information. So that's additional data OnDeck is getting. We pre-approve those accounts, and then BBVA basically markets to their customers with a loan that's powered by OnDeck, which is hugely successful. I think bank is slowly recognizing the fact that we could partner with them. We actually are feeling a product gap that they don't really have. So yeah, we have a fair amount of bank partnership under work, and also we also have partnership with guys like Intuit. Think about what percentage of the U.S. small businesses uses QuickBooks as their accounting softwares, and we're able to use those data to approve customers and market to Intuit customers directly. So I think there's a lot of partnerships in the works.
So when talking about the industry evolving and collaboration and partnership, is there opportunity for everyone up here to collaborate, or potentially, I guess, centralized fraud reporting depositories? Kathryn, do you want to touch on that point and your thoughts on that? And
Sure, and I feel kind of bad because Candace is the one who brought it up on the call the other day.
Candace, do you want to take?
Well, I'll start.
I totally agree,
yeah.
But it's her.
So we talked about the title of this panel is the evolution of peer lending marketplace, right? And so what's next? How are we going to evolve? And my answer, as we had our prep call for this panel, was, well, how are we going to start working together? I'm really sick of just seeing everyone on this panel as a competitor. And obviously, barring antitrust regulations, how can we start to work together to better benefit the borrower and one another? And there are some really easy ways for us to do that. And the first, Rohit mentioned on the data that he looks at Biz2 Credit, fraud reporting. Right now, each of us are doing our own fraud underwriting. We're doing our own risk assessments, and we don't have the benefit of the crowd. We are not crowdfunding platforms. We are underwriting in-house like bankers. We are funding the deals in-house with 5 or 6 people. Even if we do a site visit and a merchant interview, still, that's a very limited data set. And so if someone is being fraudulent, we don't know unless it's something that hits our trigger, our underwriter's trigger. As an example, many of us don't want to talk about our frauds, but I'll talk about our first fraud. We've got one now. And in that situation, the borrower had a cash flow, money coming into their account. The other lenders that were making loans to this person had filed UCCs, but they hadn't posted yet. So it looked like it was revenue coming into the bank account because it was consistent and it matched prior months. When it wasn't, it was actually other loans they were getting from other lenders. By the time we actually made the loan, they had defrauded 7 lenders. 7. And all of us lost our money. And so in an instance like that, we should have some central fraud reporting repository where we can start to trigger fraud behavior that all of us are noticing with the borrowers that we're underwriting. Many times the borrower is shopping us, and so they're talking to almost everyone on the panel here. And so what one person is uncovering should benefit the rest. We shouldn't suffer just because we only have 4 or 5 people looking at the deal. So
I would add to that, not just fraud, I would add to that just bad performers, businesses that don't pay. Mm-hmm. And so it's not always because they're really bad people and they want to defraud you. Sometimes it's because they're not really good at running their business. They took on too much capital. They have a problem with cash flow. But I think that there's not a lot of these businesses don't appear in the big bureaus like D&B. And so I think there's an opportunity to have a negative bureau, if you will, to work together for that. I've talked to Noah about that a couple times. Yeah. And I think that that's something that people want to do because frankly, it saves everyone.
I totally agree with that. You can have the best underwriting algorithm in the world. You can't underwrite bad actors. If somebody has the right business profile, cash flow, credit history to take a loan and they just don't want to pay you back, bad actors is something that you can't underwrite at the beginning. It doesn't matter how much data you look at. So I think industry, and I agree with you that if there are bad actors who's applying a loan at one place and with no intention to pay back, they're probably applying everywhere. So I totally agree with that.
And I think that we can take some direction from the marketplace lenders in the UK and other countries who have been coming together on industry issues that they can all agree upon for years. In the UK, they became their own self-regulating organization, and I think that of course there are going to be issues that we can't agree on this panel as it relates to pricing and brokers and stacking and all that other stuff. But there is a set of issues of best practices that I think that we can come together as an industry to address, and we haven't done so yet. So I think it's time.
So when talking about how there's some issues that you can all agree on, but other issues that you won't agree on, it makes me think about differentiation. So I'd like to hear from each of you how you guys differentiate in the market in which you operate, and why, if you're an investor or a borrower, you should be coming to your firm as opposed to some of your competitors.
Yes, as mentioned, I mean, we're differentiated largely in terms of the demographic we're looking at. So our borrowers are people 20 to 35 years old, tend to be actually late 20s. They are referred to as kind of millennials these days. And from an investor perspective, what we've uncovered is a whole segment of the population, the consumer lending space, that really was untapped, and people were just not looking at the risk, we think, in the right way. So through the underwriting that we've developed, by adjusting FICO, looking at additional variables as an indicator of performance, such as income, such as the college you went to, the SAT scores you got, as well as a host of other variables, we think that actually we've uncovered now a huge amount of prime and emerging prime risk. So I think, from an investor perspective, a huge new pool of investable paper, and from a demographic that is, by definition, the future of America, and one that I think is actually probably more resilient in a downturn, because when you're looking at the people early on in their careers, if they do lose their job, anecdotally, it's obviously easier to find another job when you're younger versus when you're older. From the borrower perspective, our whole approach is completely different to the other consumer lending platforms out there. Not only from an underwriting perspective, which actually incorporates a manual underwriting element in every application that we actually we do, and if anyone's interested in that, I can talk about that afterwards. But the whole experience is very different. So we touched on speed before. I think that is very important for everyone. For people from millennial demographic that we're serving, the speed is important, but it's more about the decision. So the funding can come later, but we aim to, respond almost immediately to every inquiry we get, as in terms of a yes, no, and a rate. But it's the actual experience in terms of the customer service and I guess the feel and the elements that are more difficult to quantify that really differentiate us to a lot of the other platforms, and that's actually starting to come through now in a lot of the referrals that we're getting. So customer service has been actually our biggest value prop to date, even though we're super competitive on rates. So that was something that's been quite surprising, but something we would focus on as a company.
Interesting. Candace.
So as I mentioned before, we're mid-market, which means we have to differentiate both upmarket and downmarket. As we differentiate with the upmarket players, the upmarket marketplace players, we have a couple of key differentiators. The first is that we will fund deals that have hair on them. So whether that's black marks on personal credit, lumpy cash flow, seasonal businesses, these are businesses that will not get funded by a funding circle or a foundation or others in the upmarket space, and we will fund them. And so that's one of our key differentiators. And the reason for that is our second differentiator at market, and that's because we have multiple products. And so, and our products allow us to take cash control. And so because of that, we're able to manage default risk, while at the same time giving the borrower the product that they actually need, even if they have a slightly difficult story to tell to their lender. As we differentiate down market, our prime differentiator that we consider important is transparency in pricing. And so oftentimes we're spending quite a bit of time with our borrower educating them on the difference between a buy rate or a factor rate and an APR, educating them on what they're paying on a daily interest rate versus what they're paying annually, and making sure that they understand what their all-in cost is. And so, even as we will continue to move down market, and you'll see us innovate with new products in 2015 that are down market products, but they'll all be based on an APR. And that's something that we think is quite different than the players who are down market.
Great, thanks, Candace. So, OnDeck and Kabbage, you guys are probably the two most similar companies up here. I'd love to hear which one of you wants to go first as to how you differentiate.
Yeah, man, I think.
That was cheating. I'll go.
Sorry, I didn't tell you
much
guys
you didn't
about-
have the
I
last
didn't tell
word,
you guys
actually,
about this rivalry, pre.
It was like a debate in that
pre-conference.
Yeah.
Gloves are coming off, folks. It's getting more fun now.
No, I mean, I think the most critical thing as a lender is, a couple of things. Speed and convenience is absolutely very important, and the customer experience is very, very important. So if you look at our NPS score, which is a measure of customer service, which is in the 70s, which is probably not really good if you're third grade math, but if you think about like customer experience scores, in the bank channels are in the 30s, right? So our customer experience scores are on par with Apple's and Amazon's. We're absolute advocate of small businesses, and we have a very consistent credit model. The loan process is almost seamless when they come to OnDeck to borrow. And I think our credit model has been very consistent, and the product is very sticky. I think once people go through the first OnDeck loan, the likelihood that they take second, third, fourth loan actually goes up very quickly. So if you look at our repeat customers, it's very, very stable. And I think we also have multiple products. So we have a term loan product and we have a line of credit product for customers as well as for different use. And I think from the investors' perspective, I think it's also OnDeck is very interesting because you can sort of choose to invest based on your risk tolerance. So you might be a hedge fund that's chasing for yield, and you would like to own a whole portfolio of whole loan and go leverage that up by yourself, or you might be an insurance company who would rather take lower risks, so you can invest in securitizations that OnDeck has put out in the market, where OnDeck holds 100% of the risk. So people get a lot more comfort that OnDeck actually takes the credit risk, and we have a first loss position in those. And I think that benefits our marketplace investors as well. The people who buys whole loans gets comfort level that they're buying the same loans that OnDeck retains over time. It's a random selection process. So I think it makes us a much more attractive platform to the investors as well.
I mean, I would have to say all the same stuff that you just said. Our NPS scores are the same as yours, and the process is fast, and people like it and stuff. I mean, I think some of it. I think there are probably two things I would say if I'm just going to compare us to OnDeck, and it's not favorably or unfavorably, just different. So I think we started as a technology company first. We, more than half of my employees, I only have 130 of them, are on the technology side. They're developers. We're building new products. We're, working with partners, and I think that we probably position ourselves a little bit differently. I think the other one is acquisition and customer acquisition. Fewer than 2% of my customers are referred to me by a broker or an agent. They come from partnerships, they come from SEM and SEO and advertising and those types. And so I measure my acquisition cost even for a customer. OnDeck serves bigger businesses than we do. My average line of credit is $20,000 and yours is higher than that. I go up to $100,000, but not for most of my customers. So I feel like that we're serving a different market, but I measure my acquisition cost in the hundreds of dollars, not the thousands of dollars. And I think that's a difference between the way Kabbage plays in the market with the other guys like OnDeck. I don't find us to be super similar in that.
Yeah, no,
aspect.
I think people who gets into the lending space tends to focus on cost of fund, but they don't actually think about customer acquisition costs. I think that's a huge thing that people tend not to think about. And I think if you look at OnDeck, I mean, if you roll back the clock 2 years ago, was probably 90% broker originated paper. A lot of ISOs out there, and and you originate through brokers. And I think what OnDeck has found and learned over the years is that it's very important to build direct customer acquisitions. So we hired Andrew Gella out of American Express, who ran their marketing program for Open, which is their small business, and we spent a lot of resources into the direct marketing channel. So if you look at current portfolio, on a monthly origination, probably over 60% are direct customer that we acquired through direct mail, TV ads, SEOs, SEMs, and I think those are people. Those are customers that are probably much more longer term customers because they're not being shopped by brokers. And I think at the same time, they're probably better quality customers because you control the customer experience and data acquisition and process much better. They create much longer lifetime value.
Well, at this point, I'd like to thank our panelists, but also open it up for Q&A. If anyone's got any questions. Late in the day. No questions. Okay.
Another one.
Oh wait, there we go.
So you mentioned, Candace, about the issue of fraud, and that they defrauded 7 other lenders. So was this a scenario where maybe a company had 8 employees, they were shopping around to 8 different lenders, and then they got approved by all 8, and then they hit the fund button? Is that kind of what happened? And if it's not what happened, is that a risk? Could somebody technically, if you can get funded in 7 minutes, can somebody technically shop around to other lenders who fund in 7 minutes, get approved, click accept, and suddenly the money's in the account from 10 different lenders?
So oftentimes the way that we know that someone's receiving a loan, there are a number of different things that we look at, but most often it's when we look for a UCC filing. Most of the lenders who are in our space are secured lenders, and they're doing blanket UCC filings. The problem with UCC filings is that sometimes it takes several weeks for those to post and for us to have access to them. And so if a borrower is getting funded by 3 or 4 different lenders, that's the one good thing about a broker, is that a broker will tell us if they're getting funded somewhere else. And so if someone's coming through organically, we don't necessarily know if they're shopping us and if they're going to other lenders. And our process tends to take a little bit longer. And so in the 7 to 10 business days, typically we will see the first UCC filing hit. But in this instance, it was a fast funding. It was a 4-day funding, and we didn't see those filings. And no one else did either. So it is quite possible. Now I will say that there are about 30 different data points we're looking at, and there are typically, when you see a fraudulent borrower, there are a number of different factors that tell you they're fraudulent, and we made a mistake, quite honestly, on that because we didn't call their customers, and we could have. If we would have done so, we would have realized that they had shut down a month earlier. That's a lesson learned from a startup company. But what I would say is 6 other lenders made the same mistake, and there was no way to find that out until a month later.
I'd love to add on to that, if you don't mind. So one of the ways that one of the things we do, not just on fraud, but just basically on verifying the business performance, is we're looking at real time into their checking account and all the transactions. We see transactions from all these other players in the industry in our customers' accounts, and we don't fund those customers because I see that there is, even if it's a Prosper loan, even if it's, I'm sorry, we love you guys. We do. But so we look for that. We look for those types of deposits. I can distinguish between, revenue and the proceeds from a loan unless it's masked in some way, which they could do. So there's ways, there are ways they can do that. But we see it all the time. It's really remarkable.
Yeah, man, I would say fraud risk on our portfolio is actually relatively low. I mean, if you think about, it's not just the traditional identity theft, right? Because you think about for every single business application that comes in, we pull somewhere around $2,000 to $5,000 data, right? It's very hard to create a person, create a business account that has real cash flows and transaction histories, and then create a business that actually has social media profiles that mirrors the same business. So it's not so much fraud risk that we're experiencing. I mean, I think, in terms of industry registry, I think the bad actor is much more. You can run a profitable restaurant, everything checks out, you've been in the business for 10 years, but you know what? You just decided to take a loan and
go to Vegas.
Yeah,
we had a borrower.
And that there's no underwriting. There's nothing you can guard against. So I think it's not so much fraud risk that we're worried about. It's more bad actor.
One more.
Ladies first.
I'll start, and you guys can tell me what you think if you want to add on to it. But we basically have 4 things that we have to spend money on. There's cost of capital, there's cost of acquisition, there's cost of losses, and there's cost of people. So obviously you're trying to manage all those things. I doubt that anybody at the table is going to tell anybody what any of those things are or what the ranges are. I'm just guessing. Am I wrong?
No, but I think one thing that you said earlier is that there are some costs that are better than others, and so the cost of direct acquisition, for instance, is a much healthier cost than the cost of indirect acquisition, and so we are actively working to win ourselves.
Your attention. This is your Emergency Action Plan Director.
Wow.
42nd Street, 7th Avenue to 8th Avenue is closed in both directions to pedestrian and vehicle traffic. Activity. There's a possible jumper on top of a building on 42nd Street. I repeat, traffic in both directions is closed
Okay, I think that's enough.
All right,
pretty
well, the
much right
panel
where
is
we
now
are.
going to be 3 hours long. We're going to have some time here.
Questions?
I didn't think the Crowdfinance conference is so depressing. Just a jump on it.
It's the lawyer panel. You missed the lawyer panel.
Something I said? No.
Well, that was perfect timing because I think we're out of time anyway. So thank you to our panelists.